Most traders believe their problem is the strategy. They believe if they could just find the right setup, everything would finally fall into place. A better indicator, a cleaner entry, a more precise system. The assumption feels logical. If results are inconsistent, the method must be wrong. So the search continues. New tools, new rules, new charts. And yet something strange happens. The strategy changes, but the outcome does not. Losses still appear in clusters. Good setups are missed. Winning trades are closed too early. Losing trades stay open longer than planned. The trader tells himself the market has changed again. But deep down, there is a quiet suspicion that something else is happening. What most traders do not notice at first is that trading is not simply a technical activity. It is an emotional exposure to uncertainty and financial risk. The moment real money is involved, the nervous system reacts in ways that analysis cannot control. When you open a position, your brain does not see a chart. It sees potential gain and potential loss, and the body responds immediately. Heart rate changes, attention narrows. Small price movements suddenly feel significant. The trade is no longer just a probability on a screen. It becomes a personal experience. This is where the difference between knowing and believing becomes visible. Most traders understand intellectually that losses are normal. They understand that every strategy contains losing trades. They say the words easily. But when a trade actually moves against them, the body reacts differently. The loss feels like danger. Not physical danger, but psychological discomfort. The mind begins searching for relief. Sometimes relief appears as closing the trade early. The position is still valid, but the discomfort is strong, so the trader exits just to remove the feeling of uncertainty. Other times, relief appears in the opposite direction. The stop loss is moved further away because accepting the loss feels worse than staying in the trade. From the outside, these actions look irrational, but from the inside, they feel completely reasonable in the moment. The market is not creating these reactions, it is revealing them. A trader may spend years studying charts without realizing that the real challenge is not predicting price movement. The real challenge is remaining emotionally stable while uncertainty unfolds. Every trade exists in an environment where anything can happen. No pattern guarantees the next outcome. Even a strong setup only expresses its advantage over many trades. The individual trade remains uncertain. When this truth is accepted deeply, something important changes in the mind of a trader. The outcome of a single trade stops carrying emotional weight. A loss is no longer interpreted as failure. It becomes part of the statistical flow of the strategy. The trader no longer needs the next trade to prove anything. The only responsibility is to execute the process correctly. But reaching that state requires more than understanding the concept. It requires observing how the mind actually behaves in real time. Most traders spend hours studying the market, yet almost no time studying themselves. They record charts. They record entries and exits. They analyze technical performance in detail, but they rarely record what they felt while making the decision. Without that information, an important part of the picture remains invisible. Imagine two trades that look identical on the chart. Same setup, same entry, same stop. One trade is executed calmly because the trader feels neutral. The other trade is entered while the trader is frustrated after a previous loss. Technically, the trades are the same. Psychologically, they are completely different. The second trade carries emotional pressure. If it moves slightly against the position, the frustration from earlier losses returns quickly. The trader may close the trade early or increase size trying to recover. The decision no longer follows the strategy. It follows the emotional state. This difference cannot be seen on a chart. It can only be seen through honest observation of the internal experience. This is where journaling becomes valuable. A psychological journal is not about recording performance statistics. It is about documenting the internal environment in which decisions are made. Before entering a trader pauses briefly and writes a few simple observations. How does the body feel right now? Calm or tense? Focused or distracted? Is there frustration from earlier trades? Is there excitement from recent profits? These details seem small, but they reveal patterns over time. For example, A trader might notice that trades taken during emotional tension often lead to rule violations, or that profitable trades tend to occur when the mind is quiet and patient. The journal slowly exposes the relationship between emotional state and decision quality. During the trade, the mind continues reacting to price movement. Small impulses appear. The urge to close early, the temptation to adjust the stop, the sudden idea that the market might reverse. Most of these impulses disappear quickly, but they influence behavior when they remain unnoticed. Writing them down changes the relationship with them. The trader begins to see that an impulse is simply a temporary reaction. It does not require action. After the trade, the journal becomes even more revealing. A winning trade might produce excitement and confidence. A losing trade might produce irritation or doubt. Neither reaction is wrong, but both contain information about the beliefs operating beneath the surface. If a loss creates strong emotional discomfort, it may indicate that the trader still expects the strategy to avoid losses. The belief in certainty has not fully disappeared. If a win creates overconfidence, it may indicate that the trader is attaching identity to short-term outcomes rather than the long-term process. The journal slowly turns these invisible beliefs into visible patterns. Over weeks and months, the trader begins to notice something subtle but powerful. The same emotional reactions appear repeatedly. Fear after several losses. Urgency after missing a move. Confidence expanding too quickly after a winning streak. These patterns are not random. They are expressions of how the nervous system responds to risk. The goal of journaling is not to eliminate emotion. While emotion is a natural part of human decision-making, the goal is awareness. When awareness increases, something important becomes possible. The trader can experience an emotion without automatically acting on it. Fear may still appear when a trade moves against the position. But instead of immediately closing the trader recognizes the sensation and remembers the plan that was defined before entry. The decision returns to the process rather than the emotion. This shift is quiet. It does not feel dramatic, but it marks the beginning of professional stability. A disciplined trader is not someone who feels nothing. It is someone who understands what they feel and chooses behavior deliberately. Most people search for an edge in the market itself. A pattern that predicts price movement more accurately. A strategy that eliminates uncertainty. But uncertainty cannot be removed from trading. It is the nature of the environment. The real edge appears when the trader becomes stable inside that uncertainty. Small position size helps create that stability. When risk is controlled, the nervous system remains calmer. Decisions become clearer. The trader can observe the market without feeling personally threatened by every movement. This is why survival comes before profit. A trader who protects capital and emotional balance can remain in the game long enough for probabilities to work. A trader who constantly increases risk in search of faster results usually destroys the conditions required for clear thinking. Over time, the journal becomes more than a notebook. It becomes a mirror. Each entry reflects the state of mind behind the trade. Each pattern reveals how the trader responds to uncertainty. Slowly, the identity begins to change. At the beginning, trading often feels intense. Every position carries emotional pressure. Each result seems important. Why? Later, something different appears. Trades become quieter experiences. The focus shifts from outcome to execution. Losses occur without emotional shock. Wins occur without excitement that distorts judgment. The trader is no longer chasing certainty. The trader is practicing consistency. And consistency does not come from the chart. It comes from the mind that is looking at the chart. At the beginning of a trading journey, most people focus almost entirely on the chart. The screen becomes the center of attention. Candles move, indicators change, patterns appear and disappear. The trader studies these movements with the belief that somewhere inside this information there must be certainty. The search can last for years. Another indicator is added. A new strategy is tested. A different time frame is explored. Each change brings a short period of hope. For a moment, it feels like the missing piece has finally been found. But slowly, the same problems return. Trades are skipped, stops are moved, Size increases at the wrong time. Discipline fades when emotions rise. The strategy changes, but the behavior remains familiar. This is the moment when some traders begin to realize that the market is not the only system operating during a trade. There is another system running quietly in the background. The human nervous system. When financial risk appears, the brain reacts in a predictable way. It tries to protect the individual from potential loss. This reaction is ancient. Long before charts and markets existed, the same mechanism helped humans survive dangerous environments. In trading, the danger is not physical, but the brain does not fully separate the two. Loss still feels threatening. Uncertainty still creates tension. That tension influences perception. When the nervous system is calm, the trader sees the market clearly. Price movement is simply information. The plan defined before the trade remains easy to follow. When the nervous system is activated, the experience changes. Attention narrows. Small fluctuations feel larger than they are. The mind begins searching for ways to remove the discomfort quickly. This is where many rule violations begin. A trader who normally follows the plan suddenly moves the stop loss. Not because the analysis changed, but because the emotional pressure increased. The adjustment creates temporary relief, even if it damages the long-term expectancy of the strategy. Another trader closes a position early. The setup remains valid, but the uncertainty feels uncomfortable. Ending the trade removes the tension. The mind interprets this relief as a good decision, even if the trade later reaches its target. Without awareness, these behaviors repeat again and again. The trader may believe the problem is discipline or willpower, but willpower alone rarely works for long. Emotional reactions return because they originate from deeper beliefs about risk and loss. Many of these beliefs formed long before the first trade was ever placed. Some people grew up in environments where money was associated with stress or conflict. Others learned that losing money meant failure or irresponsibility. These early experiences quietly shape how the mind interprets financial risk. When trading begins, those beliefs follow into the market. If loss is unconsciously associated with personal failure, every losing trade will trigger strong emotional resistance. The trader will try to avoid losses at all costs. Stops will move. Positions will close too early. The strategy becomes distorted by the desire to escape discomfort. If risk is associated with recklessness, the trader may hesitate before entering valid setups. Even when the plan is clear, the body resists the action. The trade passes without participation and frustration grows. These reactions are not signs of weakness. They are expressions of internal programming that has not yet been examined. The market simply exposes them. A psychological journal creates the space to observe these patterns directly. Instead of focusing only on price movement, the trader begins observing the internal environment surrounding each decision. Before entering a trade, a short pause is taken. The trader writes a few sentences describing the current state of mind. Is the mind calm or restless? Is there pressure to recover a previous loss? Is there excitement after a recent win? These observations require honesty, but not judgment. The purpose is not to criticize the emotion. The purpose is to notice it. Once the trade is open, the experience continues to unfold. Price moves up and down. With each movement, the mind produces interpretations and impulses. The impulse to close the trade early may appear after a small gain. The impulse to widen the stop may appear when price approaches the risk level. The urge to add size may appear when the trade begins moving quickly. These reactions are normal. They happen to nearly every trader. But when they remain unnoticed, they control behavior automatically. By writing them down, the trader changes the relationship with them. An impulse becomes an observation instead of an instruction. The trader can see it without immediately acting on it. This simple shift increases psychological distance between feeling and action. After the trade ends, the reflection becomes deeper. If the trade was a loss, the trader writes honestly about the emotional response. Was there frustration? Was there acceptance? Did the loss feel normal or did it feel personal? If the trade was a win, the same reflection continues. Did the profit create excitement? Did confidence increase quickly? Was there a sudden desire to trade again immediately? These small details reveal the emotional rhythm of the trader. Over time, patterns begin to emerge. Losses early in the day may influence later decisions. Winning streaks may gradually increase risk tolerance. The periods of fatigue may lead to impulsive entries. The journal transforms these invisible tendencies into visible data. And something interesting begins to happen as awareness grows. The trader starts noticing emotional signals earlier in the process. Instead of realizing the mistake after the trade, the trader recognizes the emotional pressure before the decision is made. For example, the trader may sit down at the screen and immediately sense impatience. The mind wants action, even though no clear setup exists. In the past, this feeling might have led directly to a forced trade. With awareness, the trader pauses. The journal entry might simply say, "The mind feels restless today. No clear setups yet." Wait. This moment of patience protects capital and preserves psychological stability. A trade that never happens can sometimes be the most profitable decision of the day. Slowly, the relationship with trading changes. The focus moves away from predicting every market movement. Instead, the attention shifts toward maintaining a stable internal state. A stable trader sees the market with greater clarity. Decisions become simpler because they are not clouded by emotional urgency. This is why small position size plays such an important role in professional trading. When the size of a position is large relative to the account, every price movement feels important. The nervous system reacts strongly because the potential loss carries emotional weight. When position size is modest, the same price movement feels manageable. The trader can observe the trade without feeling personally threatened by it. Clarity increases when pressure decreases. Many traders believe larger size will accelerate success. In reality, larger size often accelerates emotional instability. The mind becomes reactive instead of deliberate. Professional consistency grows in the opposite direction. Risk remains small enough that the trader can remain calm across many trades. This calm state allows probabilities to unfold naturally over time. A single trade no longer needs to be right. The only requirement is that each trade follows the same process. Entry defined, risk controlled, outcome accepted. The journal supports this mindset because it constantly returns attention to the inner process rather than the external result. Instead of asking whether the market behaved correctly, the trader begins asking a different question. Did I behave correctly? If the answer is yes, the trade is considered successful even if it produced a loss. If the answer is no, the journal records the moment where emotion replaced discipline. Each entry becomes a small lesson. Gradually, the identity of the trader begins to shift. The emotional highs and lows that once dominated the experience start to fade. Trading becomes quieter and more methodical. The market continues moving with the same unpredictability as always. But the trader interacts with it differently. There is less urgency, less frustration, less need to control every outcome. There is simply the process repeated again and again with calm attention. And over time, that calm attention becomes the real foundation of consistent performance. For many traders, the most difficult transition is not learning a strategy. It is learning to accept the nature of uncertainty. The mind naturally searches for stability. It wants clear answers and predictable results. In most areas of life, effort produces relatively consistent outcomes. If you practice a skill long enough, improvement follows. If you work longer hours, income often increases. Cause and effect feel reliable. Trading does not behave this way. A trader can follow the plan perfectly and still experience a loss. The decision can be correct while the outcome is negative. This contradiction creates discomfort because the human mind expects effort to immediately produce reward. When that expectation meets the reality of probabilistic outcomes, the nervous system becomes confused. The trader begins questioning the strategy even when the strategy remains statistically sound. Doubt appears not because the system changed, but because the sequence of outcomes feels uncomfortable. Without awareness, this doubt leads to constant adjustment. Rules change after small losing streaks. New indicators appear in search of reassurance. The trader attempts to remove uncertainty through analysis, even though uncertainty is built into the environment. The deeper skill is learning to operate within that uncertainty without emotional disturbance. This begins with a quiet shift in perspective. Instead of evaluating success trade by trade, the trader begins evaluating behavior. Each trade becomes a small opportunity to practice execution. The question becomes simple. Was the plan followed with clarity? If the answer is yes, the process continues. If the answer is no, the journal becomes the place where the reason is explored. Most rule violations follow recognizable emotional patterns. One of the most common is the desire to recover quickly after a loss. A losing trade creates psychological tension. The mind wants balance restored as soon as possible. This creates the temptation to enter another trade immediately, even when conditions are not clear. The action provides temporary relief because it feels like progress, but often the next trade carries emotional urgency rather than calm analysis. The result is another mistake. Another pattern appears after a series of winning trades. Confidence increases gradually, and with it the feeling that the market is currently easy to read. Position size may increase slightly. Rules become flexible. Marginal setups begin to look attractive. The trader does not notice the shift immediately because the emotional state feels positive. But this confidence often leads to exposure just before the inevitable losing trade appears. When that loss occurs, it feels larger than expected, not only financially, but emotionally. The mind was prepared for continuation, not interruption. The purpose of journaling is to recognize these cycles early. By documenting emotional states before and after trades, the trader begins to see the rhythm of confidence and doubt. The rise and fall of emotional intensity becomes visible across many entries. Once these cycles are visible, they become easier to manage. For example, a trader reviewing the journal might notice that most impulsive decisions occur after 2 consecutive losses. The pattern repeats often enough to become predictable. With this knowledge, a simple rule can be introduced. After 2 losses, the trader pauses for a short break before considering another trade. This small adjustment protects the decision process during moments of emotional pressure. Another trader might notice that the most disciplined trades occur when the emotional state is calm and neutral. The journal entries from those periods describe patience and clarity. Trades from highly emotional days show more rule violations. This observation leads to a powerful realization. Emotional regulation is not separate from trading performance. It is directly connected to it. The nervous system acts as the operating environment for decision-making. When the environment is unstable, decisions become unstable as well. This is why many experienced traders focus more on internal stability than external prediction. They understand that the market cannot be controlled, but their own state of mind can be observed and regulated. Simple practices help maintain this stability. Taking breaks between trades, limiting the number of trades in a session, keeping position size small enough that losses remain emotionally manageable. These practices do not guarantee winning trades. What they guarantee is a consistent decision process, and consistency in behavior is the only condition under which a strategy can reveal its true probability. Without consistent execution, even a strong strategy appears random. The results become a mixture of disciplined trades and emotional decisions. Performance cannot stabilize because the process itself changes constantly. The journal gradually reduces this variability. Each entry reinforces the habit of observation. Instead of reacting immediately to every thought or impulse, the trader becomes curious about it. Why did that urge appear? What emotion is present right now? This curiosity replaces judgment. The goal is not to criticize mistakes, but to understand the conditions that created them. Understanding leads to patience. Patience allows the trader to wait for valid setups instead of forcing activity. It allows losses to occur without triggering immediate retaliation. It allows profits to be accepted without excitement that distorts the next decision. Over time, this patience creates a quieter relationship with the market. Trading sessions begin to feel less intense. The chart is still observed carefully, but the emotional pressure around each movement decreases. The trader is no longer trying to control the next outcome. The focus remains on executing the same process again and again. There is an important reason this calm approach produces better long-term results. Financial markets reward consistency across large samples of trades. A strategy that has a small statistical advantage only expresses that advantage through repetition. Individual outcomes vary, but the overall distribution eventually reflects the probability. If emotional reactions constantly interrupt execution, the sample becomes distorted. The trader may skip valid setups and take invalid ones. Position size may fluctuate based on mood rather than plan. The statistical edge never has the opportunity to appear clearly. When execution becomes stable, the edge becomes visible. Losses still occur, but they feel expected rather than threatening. Wins occur, but they do not create overconfidence. The account grows slowly because the process remains steady. This slow growth is often misunderstood by newer traders who expect rapid results. But professionals understand something important. Survival is the first achievement in trading. Remaining consistent long enough to allow probabilities to work is far more valuable than occasional large gains followed by emotional drawdowns. Small position size supports this survival. It reduces the emotional intensity of each trade. It keeps the nervous system within a range where rational thinking remains accessible. The trader begins thinking like a risk manager rather than a gambler. Every decision becomes part of a long sequence rather than a single moment of success or failure. The outcome of one trade becomes almost insignificant compared to the stability of the process. At this stage, the journal no longer feels like an obligation. It becomes a natural extension of the trading routine. The trader writes not because it is required, but because it clarifies thinking. Each entry slows the mind just enough to notice subtle emotional signals. Those signals once controlled behavior. Now they simply provide information. This is the quiet transformation that many traders experience after months of honest journaling. The external activity of trading remains the same. Charts still move unpredictably. Setups appear and disappear. Losses and wins continue to alternate. But internally, something has changed. The trader is no longer reacting automatically to every movement. There is space between stimulus and action. In that space, discipline becomes possible. And discipline repeated over time gradually becomes consistency. In the early stages of trading, the experience often feels intense. Every movement in the market seems important. Every trade carries emotional weight. The mind constantly evaluates whether the decision was right or wrong. When a trade wins, there is excitement and relief. When a trade loses, there is tension and frustration. This emotional cycle can continue for a long time because the trader believes the answer must exist somewhere inside the chart. More study feels like the solution. More analysis feels like progress. But slowly a different understanding begins to appear. The trader realizes that the market itself has not changed. The uncertainty was always there. The probability structure of trading was always the same. What has been changing is the trader's reaction to that uncertainty. At first, this realization can feel uncomfortable because it shifts responsibility inward. It is easier to believe that success depends on discovering the perfect method. It is more difficult to accept that stability must come from within the person making the decisions. Yet this acceptance is where real progress begins. When responsibility becomes internal, the focus naturally moves away from controlling outcomes and toward controlling behavior. The trader stops trying to force the market to cooperate and instead begins refining how they respond to whatever the market does. The journal supports this transition quietly. Each written entry slows the trading process just enough to introduce awareness. Before a trade, the trader pauses and observes the internal state. During the trade, the impulses and reactions become visible. After the trade, the emotional response is acknowledged without judgment. Over time, this repeated observation builds familiarity with the inner landscape of trading. Fear no longer appears as a sudden, overwhelming reaction. It becomes a recognizable signal that the mind is seeking safety. Excitement after a winning streak becomes recognizable as well. The trader sees how quickly confidence can expand when outcomes have been favorable. Neither emotion needs to disappear. They simply need to be understood. Understanding creates stability. When the trader recognizes the emotional pattern early, the decision process remains intact. A moment of frustration does not automatically lead to revenge trading. A moment of excitement does not automatically lead to increasing position size. The trader notices the emotion and continues following the plan that was defined before the trade. This is the quiet discipline that defines professional trading. It is not dramatic. It does not feel heroic. It often feels calm and uneventful. But that calmness is exactly what allows the strategy to operate correctly over long periods of time. Professional traders rarely describe their work as exciting. Most describe it as repetitive and structured. The same preparation each day, the same risk parameters, the same patience while waiting for conditions that match the plan. From the outside, this routine may look simple. From the inside, it represents a stable relationship with uncertainty. The trader understands that the next trade may win or lose, and that both outcomes are acceptable within the larger sample. Because of this acceptance, the mind remains balanced. Balance allows clear observation. Clear observation allows precise execution. Precise execution allows probability to express itself across many trades. And when probability is allowed to operate without emotional interference, the results begin to stabilize. The account does not grow in dramatic leaps. Growth appears gradually through steady risk management and consistent behavior. Said losses occur, but they remain contained because the process remains disciplined. This steady progression changes how the trader views the market. Instead of searching for certainty, the trader becomes comfortable with probability. Instead of chasing large gains, the trader focuses on protecting capital and maintaining clarity. Instead of reacting emotionally to every movement, the trader observes the environment with patience. Small position size continues to play an important role in this stability. When risk per trade remains modest, the nervous system stays within a manageable range of activation. The trader can think clearly even during temporary drawdowns. Losses feel like normal business expenses rather than personal failures. This emotional neutrality protects the quality of future decisions. Many traders underestimate the importance of this balance. They assume profitability comes from predicting the market better than others. In reality, profitability often comes from managing oneself better than others. The market offers the same uncertainty to every participant. What separates consistent traders from struggling traders is not access to different charts or different information. The difference is psychological stability. A stable trader does not need the next trade to confirm intelligence or worth. The outcome is simply part of the statistical process. Because identity is not tied to individual results, the trader remains calm, regardless of short-term fluctuations. The journal strengthens this perspective because it constantly reflects behavior back to the trader. After months of honest entries, a clear pattern usually appears. The best trading periods are not the ones with the most excitement. They are the periods where the mind felt steady and patient. The worst trading periods are rarely caused by the market alone. They are often associated with emotional tension, impatience, or fatigue. Seeing these patterns repeatedly changes how the trader prepares for each session. Preparation becomes less about predicting direction and more about maintaining the right internal conditions for disciplined execution. Adequate rest, clear risk limits, a calm starting mindset. The trader approaches the market as a professional environment rather than an emotional challenge. This shift transforms the meaning of success. Success is no longer defined by a single profitable trade. It is defined by the ability to repeat the same disciplined process regardless of recent outcomes. If the plan is followed, the day is considered successful. If emotions override the plan, the journal records the moment where awareness was lost and the process begins again the next day. This long-term perspective removes much of the pressure that once surrounded each decision. The trader understands that mastery develops gradually. Every session contributes a small amount of experience. Every journal entry refines awareness slightly. Progress may feel slow, but it is stable. Eventually, trading begins to feel different from how it felt in the beginning. The intense need to control outcomes fades. The market becomes something to interact with rather than something to defeat. The trader sits in front of the chart with quiet attention instead of emotional urgency. There is a plan. There is defined risk. There is acceptance that the next trade is simply one event inside a much larger sequence. From this place, trading becomes calm, precise, and sustainable. The chart still moves unpredictably. Opportunities still appear and disappear, but the trader is no longer searching for certainty within that movement. The focus has shifted to something far more reliable. The focus is on showing up each day with a stable mind, disciplined risk, and honest self-observation. Because in the end, the most important element in trading is not the pattern on the chart. It is the person observing the chart. When that person learns to remain steady in the presence of uncertainty, the entire experience of trading changes. The search for the perfect system ends. The endless switching between strategies stops. What remains is a simple process repeated with patience. Observe the market. Define the risk. Execute the plan. Accept the outcome. Record the experience honestly. Then return the next day and repeat the process again with the same calm attention. That is how consistency is built. That is how survival becomes long-term profitability. And that is why the most valuable study a trader can undertake is not the study of the market, but the study of themselves.